Some of the nation's biggest banks are getting ready to report their earnings tomorrow. J.P. Morgan, Friday, we hear from Citi, and Morgan Stanley and Bank of America are due out early next week. But as Kayla Tausche reports, there may not be much to like in those quarterly results.
Banks were supposed to be one of the bright spots in the market, but they're going to need to get through what looks to be a dismal fourth quarter of earnings before they turn around. Analysts are expecting ever so slight revenue growth of around 2%, but a sharper rise in profits thanks to massive cost cutting that is still ongoing. The street actually sees Bank of America improving the most over last year, but sees Wells Fargo's business model as being able to best stand up to recent headwinds. Some of those headwinds are too big to ignore. First, the steep decline in oil prices. Banks collectively have more than $100 billion of debt related to the energy sector. Now, most of it is high grade, but they're having to set aside more money in case of potential losses. Second, higher interest rates will mean that banks earn slightly more money on some loans they're underwriting, but there's a worry that credit quality has peaked. The number of companies and consumers defaulting on their debts is at or near an all-time low. Experts say it can only go up from here, and that's a problem as debt is getting more expensive. In the past, volatile markets like energy and interest rates would have spurred more trading activity, but executives like J.P. Morgan CFO Marianne Lake have said a seasonal slump in trading activity that has plagued recent years will also be present in the fourth quarter. We will hear from J.P. Morgan the first out of the gate for the major Wall Street banks. For Nightly Business Report, I'm Kayla Tausche in New York.